All right, so much of chapter 2, the bulk of chapter 2 work is going to be right in the very beginning. Right in the very beginning, where we are going to learn about more details about the balance sheet. Balance sheets are actually classified, and that's because there are different types of assets and there are different types of liabilities. And so when they say we have a classified balance sheet, they're simply just classifying the assets in certain categories that you're going to learn about. And they classify liabilities in a couple of categories that you're going to learn about. That's a classified balance sheet. It doesn't change that the balance sheet has assets on one side, liabilities and stockholders' equity on the other. It just says, look, there's more detail to these assets than you know, and there's a little bit more detail to the liabilities that you should know. So much of what we're going to be focused on in chapter 2 is right at the very beginning, learning objective 1, and that's going to be the focus today. When I see you again, we'll finish chapter 2. There's actually not much left of chapter 2. There's 2 learning objectives, but they're relatively brief. The first, learning objective 2, introduces you to financial ratios, and it's just an introduction. We're going to be using a lot of financial ratios in the next half of the class. So the class is 15 weeks long, give or take. Probably in those last 6 or 7 weeks, we're going to do a lot of financial analysis. In the very beginning, we're going to be doing a lot of bookkeeping. Okay, so kind of split the class up that way. And then we're going to be introducing you to GAAP and some of the rules. And that's just reading material for the most part, nothing overwhelming there. So that's chapter 2 in a nutshell. Again, much of what we're going to be doing is right in the beginning. So let's get started. Like I said, you already know that a balance sheet has assets on one side, right, and liabilities plus stockholders' equity on the other side. You already know that. That was introduced to you in chapter 1. What you don't know is that there are different types of assets. Okay, so they have what we call classifications of assets, and there are 4 of them. Okay, current assets are short-term assets, things that are going to be used up within a year. And then they have long-term assets, and there are 3 different categories of long-term assets. Okay, so we're going to be looking at each of these categories specifically. Liabilities are easy because they're only broken into 2 parts. There are what we call short-term liabilities, which in accounting we use the word current to indicate short-term. And there are long-term liabilities. In accounting, the difference between something that's short-term and long-term is 1 year. That 1 year's time frame splits up short-term and long-term. Short-term we call current. Again, we have a lot of these interchangeable terms that I was talking about. So short-term and current mean the same thing. Less than a year or less than a year. Long-term, anything over a year. So as you see, assets basically have, there are short-term assets that we call current assets. Current assets are very specific. They're either going to be turned into cash very quickly within a year, or they're going to be used and expensed within that year. So these are assets that are going to be used up very quickly within the year's period, thus the word current to indicate that they are short-term. All the other assets are long-term, which means that the business is going to use them for periods of time that are greater than a year. And there are 3 different categories, as you see. Long-term investments are assets that the company owns and they plan to use over a long period of time, but they're not used in the current business. So for example, and this is, I think it's a good example. Let's say I own a pizzeria. and I sell pizza and associated products, right? I decide that, I'm doing so well that I want to expand and put one of my pizzerias up in Kingston. So I buy a building in Kingston, but I just bought the building. I just own the real estate. I didn't open up my shop there yet. Well, I own the building, but it is not being used in the business. I just own the building. It's not a pizzeria yet. It would be a long-term investment for my company. Okay, so if I purchased real estate for future use, I own it, so it's an asset, but I'm not using it to generate any sales of my product. And so it's a long-term investment in that regard. Not a lot of companies have long-term investments. All companies that you'll see will have current assets because they all have cash, they all have supplies or inventory, Every single company you see will have current assets, so you have to know that section. In terms of long-term investments, not a lot of companies have them, but it is a classification that you need to know on a classified balance sheet. What a lot of companies will have, as I said, actually all the other companies will have, is the third category. We call it property, plant, and equipment, or we actually shorten it, PPE. Now, property, plant, and equipment are physical long-term assets. So they include land and buildings and equipment. So for my pizzeria, let's say I own my shop. So I own the land, I own the building, I own all the equipment in the building and out of the building. That's my property, plant, and equipment. I'm using all of that right now to sell my pizza. And so it's property, plant, equipment. That's how it differs from the fact that I own a building in Kingston because I want to open up a pizzeria there next year, so I bought a building. Well, the building in Kingston, I own it, but it's not generating any sales of my pizza. That's why it's a long-term investment. Property, plant, and equipment is directly related to selling my product or service. Long-term investment is not. Okay. I put a check mark here just to remind you that every business you see will have property, plant, and equipment. Just like every business you see will have current assets. Those two categories are guaranteed. You'll see them on every single balance sheet, guaranteed. Long-term investments, not so much. Some companies will have them, a lot of companies will not. The fourth category is getting more important because of how we do business today. These are called intangible assets. So something that's tangible has a physical quality, like my land, like my building, like my equipment. But these are assets that are critically important to the company that don't have a physical quality. So what are those? Well, if I have a patent or a copyright, let me give you an example. If I invented something, I would apply for a patent from the government, which would say that this is, we recognize that you're the owner of this invention. That's really what a patent is, which means that if I'm the owner of the invention, I can sell it to other businesses if they want to use it for fees, royalties, what have you, okay? So that's good to know. That's really good to know. And so a lot of companies invent things, so they have patents, and they sell the product that's based on that patent. So, for example, drug companies, when they create their own medicine, that is backed by a patent. The invention is the medicine, and they apply for a patent. So they're a recognized owner of that medicine. And they're the only ones who can sell that medicine for 20 years under the patent law, which is why we in America pay so much for new medicine. We have the benefit of having advancements in medicine that are quite rapid, but we pay top dollar in the world because, well, companies have a patent on it. They invented it, they own it. No one else can use it for 20 years. After 20 years, you might be wondering what happens to it. Anybody can make it. That's what a generic drug is. Okay, so the patent on aspirin is long gone. That's why any company can make aspirin and put it on the shelf. Same thing with Tylenol, acetaminophen. That patent has expired a long time ago. So any company in the world can make acetaminophen and put it on the shelf. But that's not true for some of the drugs that are new. Only those companies can have. Another one that's really big for an intangible asset is copyright. A copyright is also legal recognition of the government that you own something. In this case, it could be a piece of, it could be a song or music or lyrics. It could be a book. Could be a piece of art. Could be a piece of software. Could be a formula. An algorithm that you have created to track stock market, track credit scores, track what have you. Once you have the legal recognition that you own it, then other people have to pay you to use it. Okay. And that's very, very important. It's very important to know because that's the foundation of a business. So intangible assets are critically important to things like companies that, like Google, their search engine and YouTube and other, these are all intangible assets that Google is built on. Amazon has a lot of intangible assets that they build their business on. Apple has patents on all of their inventions, which has made them a very profitable company. Microsoft has copyrights on all of its software, and that's what's made it a very successful and profitable company over the years. So you have to sort of understand, Facebook is the same way. They live on intangible assets. You need a credit score, you go to a credit score company, they have an algorithm that they own that spits out a credit score. That's how they make a living, is an intangible asset. The entire company is based on intangible assets. So intangible assets are critically important for, and they're becoming more and more common. I know all of you know Disney. All the Disney characters are copywritten characters. All those stories are copywritten. So Disney owns those characters, they own those stories. And so anyone who wants to use them needs to pay Disney permission to do so, even if it's to make a plastic model for a Happy Meal. They have to pay Disney because Disney owns the character. How do we know they own it? It's an intangible asset. It's a copyright. Okay, so it's an incredibly important classification of asset today. On the other side of the balance sheet, you have liabilities is the only category that's broken. And again, it's broken into short-term and long-term. A current liability is a debt that needs to be paid within 1 year. Now, how do we know what the year is? Well, this is a balance sheet. Balance sheets have dates on them. So you look at the date on the balance sheet, compare it to the date when you owe your debt. If it's less than a year, it's a current liability. If it's longer than a year, it's a long-term liability. The wonderful news is there's no classifications of stockholders' equity. Lucky, lucky, lucky. So there are 4 classifications of assets that we just went over. Current assets and private plant equipment are going to be on every single balance sheet you will ever see. Intangible assets, as I told you, have been increasingly important over time as we become more service-based, more tech, etc. Long-term investments don't show up on a lot of balance sheets, even though they are technically a classification. Okay, but again, whether you're looking at assets or whether you're looking at liabilities, they're either going to be used up or due within the year, or they're going to be used for over a year or due over a year. That's long-term. Current and long-term are the only 2 time frames that we use on the balance sheet. Franklin Company, this is good. I think this is on page 47 in your book, if you have your book. This is a very good example to have when you're doing your homework, because it literally provides you with an order of how these assets are going to link up, list up on the balance sheet. And the order becomes important on a balance sheet. Okay. As you see, there are many, many, many current assets compared to any other category. And those are the categories. Current assets are listed first. This company has long-term investments, property, plant, and equipment, which you'll see everywhere. And this company also has intangible assets. So all four classifications are there. But these accounts are very, very important, okay? Because the list of how these are put down is extremely important. That's the thing you need to focus on, is the order. Now let me explain the order. Current assets is, again, is usually the biggest section of the asset account because there's so many of them. There's two orders for current assets. The first order is called liquidity order. That means that current assets are listed with cash first and all the other accounts that will turn into cash eventually. Okay. And then after that, usually it stops at inventory. It goes into what we consider an expense order. Okay. Current assets that are used up quickly can be expensed. So the current assets are either going to be turned into cash or they're going to be used up quickly and expensed. That's basically the bottom line. Now, when we say used up quickly, again, these are current assets, so within the year. So let me focus first on cash. Cash, again, as you probably remember from chapter 1, this is their main bank accounts, in general. Cash is already liquid. Cash is cash. And so you can go to the bank at any point in time during the day and grab your cash and go. So cash is considered the most liquid asset you can have because it is cash. A debt investment is listed next. Now, debt investments are interesting because these are basically short-term investments, either in, well, most of them are in what we call the money market. The money market is short-term lending market for the United States government, for bank-to-bank loans. Yes, banks make each other loans. And extremely large corporations that deal in something called commercial paper. Those are basically debt investments. And so debt investments are highly liquid. You can cash out of them at the end of every investment day. Okay. At the end of every investment day, you can cash out. Yes, this is definitely the order in which everything fits. So that's why I asked everyone if you could just note that page in your book, page 47. That's where this particular statement is. I think it would be very, very helpful. So bonds would be considered long-term debt investments. So they'd be long-term investments if you own them. If you owed them, they'd be long-term liabilities. Okay. Remember, there's two parties to every loan. The organization that's giving the loan and the organization that's getting the loan. So they look at them differently. Okay. So a debt investment can be turned into cash at the end of the day. So you can wait 24 hours, you get your cash. Accounts receivable, as you might recall, is when some businesses do business with other businesses and they don't, when you sell something to your customers, you usually collect cash right away. You get payment right away. However, some businesses do favors with other businesses, that they'll sell them goods today and they'll say, look, we'll wait to receive your money. Here's a bill. And those are usually due within 30 days. So accounts receivable will be turned into cash, but within a 30-day period of time. A note receivable, remember the word note in accounting means loan. In this case, you've made a loan. Well, why would companies make loans if they're not banks? Well, in this particular case, there is, I don't understand. I'm not sure I understand the question, Coral. So if I pre-ordered a game or something that I paid up front, it wouldn't be an asset for me. It'd be a liability. But maybe you could think that through and maybe re-ask the question so I can understand it better. So a note receivable, let's get back to this. A note is a loan that I've made. Now, why would I make a loan? Well, because the businesses that I've given a bill to, that I expected them to pay in 30 days, they need more than 30 days. They need 60 days, 90 days, 120 days. And so I say, look, all right, I'll give you 120 days, but I need to charge you interest. And so you can pay me 120 days from now, but you're going to owe me the balance plus interest on it. Guess what? That's a note. That's a note receivable. And so notes receivable really usually extend accounts receivable for some businesses that need more time to pay you. Okay. And again, the word note means there's an interest rate attached to it and there's a due date attached to it. Inventory is an interesting current asset because first of all, you need to know what inventory is. So I think everyone in this class has gone shopping. You've been to, whether you've been to the mall at some of the stores there, or you've been to your local Walmart or Target, you've been shopping. Well, before you walk into any of those stores, the stores have to buy all the goods and put them on the shelf. That's their inventory. Okay. What's the purpose of Walmart buying all that stuff for those shelves? Well, to get rid of it, to sell it to the customers as soon as possible. The problem is inventory is so wide-ranging. There's going to be some inventory you're going to sell right away. So if you walk into, say, a Walmart store, you're probably going to notice that they're going to be selling their fruits and vegetables and meats and breads right away because they go bad after a while. And then some things can stay on the shelf for a long time. Boxes of cereal don't have to be sold right away. Cans of soup don't have to be sold right away. Twinkies, there's enough preservatives in those that can last past a nuclear war. They don't have to be sold right away. So there's a lot of stuff that can be sitting on the shelf for a while. So inventory basically will be sold, and that means that it's going to be turned into cash. But we just don't know when. So it's listed last in the liquidity order here, because eventually we will sell it. And when you and I go shopping and buy something, we're going to be paying in cash to do so. But inventory also, once it's sold, it's turned into cash, but it also becomes an expense to the company. Companies, when they sell inventory, they call that something called cost of goods sold, which might have been mentioned in chapter 1 in the reading. But it's basically an expense of selling your goods to customers. Okay, so that's how that works. So inventory is one of those dual things. It will be turned into cash as customers purchase it, but then we will also expense what customers have bought from us. Supplies tend to be, they're also current assets because of the nature of what supplies are. So whether you need plastic bags to give customers so they can take the stuff out of the store, or if you are a Dunkin' Donuts or a Starbucks and you need cups and lids, and you need bags for your baked goods to give to customers so they can take out of the store. Those are supplies. When you buy all those supplies, they technically are your assets. You own them. You own thousands of cups and lids if you want them. But the purpose of having all those thousands of cups and lids, if you're a restaurant, is you want to put liquid in it and sell it to the customer. You don't really want the cups and the lids, and that's certainly not something you are selling. You are selling coffee or tea or frozen drinks or soft drinks or what have you. So the purpose of having those supplies is to help you deliver your product to the customer. Or if you just have a bunch of bags in the store, as customers buy stuff, you put them in the bags so the customers can carry them out. Those are also supplies. When you buy those bags up front, they're your asset. After you use those bags, after you use all those cups, they become what's called supplies expense. Now, you saw supplies expense in chapter 1 on the income statement. And that's an interesting thing because some of these assets, like inventory, like supplies, once we've used them, we can expense them. So they start on the balance sheet, but they'll end on the income statement as expenses. So whatever we use up for supplies becomes supplies expense. Whatever we use up for inventory, which means whatever we sold of our inventory, that becomes an expense called cost of goods sold. You'll learn more about that in chapter 5 and 6. Prepaid insurance. Got to remember how we buy insurance. All businesses need insurance, whether they are insuring, they have business insurance for their liability, or they're insuring vehicles. If I had a pizzeria and I had a delivery van, I would need insurance on that, what have you. Think about how you buy insurance for your automobile. You usually buy insurance ahead of time, right? You buy it for 6 months or 1 year from the day you purchased it. Well, the fact that you purchased it and you purchased a 6-month policy means that it's your asset when you buy it. Because when you buy it, you own it. You own that policy. You can't say it's an expense until you've used the insurance policy. So if I bought 6 months of insurance, I own that. It's prepaid insurance. But I'm going to use it up quickly. That's why it's a current asset, right? I'm going to be using it up within the next 6 months. After every single month of my policy, so I have 6 months policy. After a month, I have 5 months of my policy left. After a month, I have 4 months of my policy left, et cetera. Every time you use a month of your policy, you can expense that month. So prepaid insurance starts as an asset. Once we use it for that month, we show it on the income statement as insurance expense. Okay, but you have to use it before you can expense it. That's a very important little piece of accounting. Current assets are totaled. Notice in the very, very far right column of the sheet are the totals for each of the classifications. There are 4 classifications. There are 4 totals. So this is a very important one because this is going to be the one that takes you the most time to do. Current assets, again, there's quite a list of them. There's a specific pecking order for them, as I went over with you. So getting to know these means you're going to have examples in front of you when you sit down and do your homework. Don't ever think you can do this by memory, please. It's just not something that can happen. You have to have examples of these sheets in front of you to do it. It makes it more logical, it makes things flow, and it provides you with some structure. So please, please, please don't think you can sit down and just do it without the book or without examples. Always have the examples in front of you. I'm not asking you to memorize anything. I'm asking you to learn how to use the resources to get stuff done. All right, your second classification here, long-term investments, again, things that the company owns, but it's not directly related in selling the products or services that the company is doing. So the company might own stock in another company. Woohoo, big deal. Well, I don't think that's what this company does for a living. but they do own stock in another company. It is an asset to the company. You got to put it somewhere. Well, under the classifications of assets, there are only 4. It's not a current asset because you're holding it for more than a year. It's not property, plant, and equipment because you're not using it in the business right now. It's certainly not an intangible asset because it's not a patent or a copyright or whatnot. It's a long-term investment, so it's going to be stuck right here. And again, if I bought a building and I'm not using the building right now, it's also a long-term investment. Okay. Long-term investment total is 7,200 here. Property, plant, and equipment. These are tangible assets that I'm using in the business right now. So property refers to land. And again, we have equipment that's listed here as well. This is all long-term. These are long-term assets that are going to be used for a number of years. And so land is something that's always useful. Okay, unless it's underwater. But it's, it's always useful to a business. Right now there's a building on it. You can tear it down, put something else on it, tear it down, put something else on it. The land is always useful. So land is something that when we buy, we know we're going to have forever. That's the assumption in accounting. However, that's not true with if we had a building on it, which is what plant is, a building, or a factory is plant. Or if we had equipment. If you had a building, buildings only last so long for business purposes. If you buy equipment, it's only going to last so long for business purposes. And you're going to use up the value of that equipment in providing goods or services to your customers. So if I'm a pizzeria and I have a pizza oven and I have that oven blasting every freaking day, it's only going to last so long. Right? I mean, it's a piece of equipment. It's going to be useful. It's going to help me cook my pizzas and my sandwiches and other types of stuff. But, after a while, after heavy use, it's going to crap out on me eventually. So things like buildings and equipment depreciate. Means that we are going to be using a portion of the value of that equipment or of that building over many, many years. And we can actually expense the value that we've used to generate sales of our product or service. And so we have a depreciation expense that you saw on the income statement. That shows how much of our long-term assets, our property, plant, and equipment, we have expensed for that month or whatever period of time the income statement is. What we show on the balance sheet is how much, in this case, how much of the equipment we've actually expensed over time. We call that accumulated depreciation. And as you see, we bought a piece of equipment for $24,000. We have already expensed $5,000 of that equipment. So we have what we call a book value of the equipment for $19,000. That's the remaining value in the equipment for business purposes. Okay, and so that's important to know. And then, of course, we have the intangible assets listed last, and I've already talked about that at great length. So patents and copyrights would be examples of important intangible assets for businesses. Again, this is the total for the 3rd classification. This is the total for the 4th classification of assets, and these are the total assets. Okay. Very important that you spend time understanding this. Thankfully, there's only 2 classifications of liabilities, and you see them right here. So liabilities are either current, which means that they're due within a year from the date on the balance sheet. So if it's due between the date on the balance sheet and the next 1 year from that date, October 31st, 2018 would be the year, it's a current liability, would be listed right here as a current liability. If it's a debt that's due after 1 year from then, long term, listed right here. So a couple of things right here. There's a mortgage payable. So a mortgage is a loan on property or a building. You'll probably know that from a house. If you want to buy a house and you want a loan for a house, they call that a mortgage. So it's just means that it's a long-term loan. You're going to be paying mortgages anywhere from 15 to 30 years. Okay, so it's a long-term liability for companies. Notice that they have notes payable listed under current liabilities and notes payable listed under long-term liabilities. Why would they do that? Anybody know? Is there anybody here?
Is it two separate loans? Like one is a short-term loan, one is a long-term loan?
Yeah, Wanisha, that's great, right? So this note payable, which is worth $11,000, is due within a year. That's why it's under current liabilities. However, this portion of the note payable, this $1,300, isn't due until after 1 year from the date, which makes it a long-term liability. Interesting. You probably know some of these accounts. I'll review them real quick for you. Accounts payable is any bill that's due in 30 days. So you get a you get a bill, for example, from the electric company, your Central Hudson. How wonderful is that? You open it up, say, shit, I owe $100 for electric. Okay, that becomes an accounts payable for you. It's a bill that's due within 30 days. So that's that. Unearned revenue. I cannot tell you how important this account is because this is when customers pay you up front. And so it's a liability because you owe the customer what they paid for, right? And that's what I was curious about when Carl mentioned pre-orders. So if I pay up front for something that hasn't been released yet, that technically is unearned revenue. That's a liability for me because I owe the customer what they paid for. So I think that might be what you were talking about earlier, but this is really where it would be. It would be in the current liability section. If I paid for something up front and I'm waiting for the copy of my movie or my book or something, whatever I paid for up front, software, game, whatever, it's a liability until the company actually delivers the game or the movie or the book to the customer. Once, by the way, once the company, again, this is customers paying up front and you owe the customer. Once you actually provide the customer what they paid for, then you move that amount of money to your income statement under revenue. Okay. So notice there's links between the balance sheet and the income statement that will become more obvious as you study this stuff. You'll see these linkages pretty clearly. And so unearned service revenue, customers paid up front, you owe them something. Once you actually deliver what you owe, you move the money over to revenue. Revenue is earned. Unearned revenue is a liability because you owe it. If you've already delivered it, it's earned, it's revenue. So that's the difference. You'll see that with the income statement. Salaries and wages payable. It's interesting because let's say you get paid every Friday. I'm just making it up. Say you work for a company, you get paid every Friday. Are you getting paid for the week that you're just working? Anybody?
No.
Usually get paid
the week before.
Correct. You usually get paid for the week before, right? So yes, that's right, Nick. So once you actually put your time card in for that payroll, they don't pay you for another week or two, depending on what the cycle is for your paydays. Well, it has to show that the company owes the employees for these salaries and wages. That's what a salaries and wages payable is. Okay. This is the money that they owe the employees at the next payroll. Okay. The next pay period. They owe it because you've already worked for it. So they're going to pay you. So it's a liability. Interest payable, again, you have, if we go back to you have notes receivable and you have notes payable and so forth. Well, notes payable has interest. You owe a certain loan on a certain day with interest. Well, even if it's a 3-month loan, so I got the loan today, I don't have to pay it till December. Interest is going to pile up every day until it's due in December. So the interest that piles up for the month of October, I can expense in the month of October. The interest that piles up in the month of November, I will expense as interest expense in the month of November, even though I'm not paying that until the loan is due in December. So how do I show that I still owe the interest? That's what interest payable is. Good news, like I said earlier, there's no changes to stockholders' equity. Woo! Right? There's only 2 main accounts. Common stock, which is what the owners put into the company in exchange for shares of ownership. That has to happen. That happens before the business really starts. Right? Before you start a business of any kind, you put money in exchange for ownership. In this case, the corporation, the investors are putting cash in. What are they getting back for that cash? Common stock, which is shares of ownership. So that happens right up front. This represents the amount of paid in capital, how much the owners have paid in to the company. Retained earnings, as you know from the retained earnings statement, the amount of the profit. Remember, who owns the profit? I'm not talking Ezekiel or Isaiah. I'm talking about the net income, okay? Who owns the profit? I will tell you who owns the profit. The stockholders, the owners own the profit. And so the retained earnings statement tells us the story of that profit or net income. How much of it is sent out in a dividend? The rest of it is retained, kept in. The owners want it kept into the business. Well, they show it here. It's the owner's property. It's an owner's account. Retained earnings is shown right here. Okay. Again, when we total stock liabilities and stockholders' equity, it's going to equal the total assets. I also need you to notice too, as I didn't point this out earlier, is we always total current assets on the asset side. We always total current liabilities on the liability side. So that's important as well. The rest of this part of the chapter basically just sort of explains what I was explaining. It gives you a few other examples here. This is a partial balance sheet emphasizing current assets at Southwest Airlines. And you see that. Okay, so the balance sheet has to balance. The assets have to balance out with the liabilities and stockholders' equity. And here's a good example for you, Michelle, and others that have the same question. Let's say you wanted to buy a car. It would say it was a used car, and it was $10,000. How do you buy a $10,000 car? Well, you need $10,000 of financing to buy a $10,000 car. So the financing is the liability and equity section. So if you wanted to buy a $10,000 car, you might have $2,000 saved up as a down payment for that car. That's your equity. And you might need an $8,000 loan. That's your liabilities. So even if you bought a $10,000 car, you would need $10,000 of liabilities and equity to buy the $10,000 asset. And that's why a balance sheet works this way. Assets, you cannot get a $10,000 car without $10,000 worth of financing. Just like you couldn't purchase your college education without the financing to buy it in full. You can't buy a $10,000 college education without $10,000 of resources. And so they have to match. The balance sheet kind of looks at things that way. And I hope that explains things a bit to everybody. So again, your current assets section is listed here for this particular company. These are just examples in your book. Long-term investments, they're not known. This is from Google. They have a little bit of long-term investments, whoopee ding. Property, plant, and equipment, again, it explains this idea. They have to be currently used in the operation of the business. They have very long, useful lives for the business. Like I said, if I'm buying a pizza oven, I'm going to be using that thing for 10, 15, 20 years. Okay. Here is a partial balance sheet showing property, plant, and equipment for Tesla. Okay. And the totals here. And then intangible assets are very, very important. They don't have a physical substance to them because it's an intangible asset. So it's not a building or a piece of equipment. It's literally a piece of paper that proves ownership. Okay. And so here we show Disney, showing Disney with its characters and its licenses and its trademarks as very, very important intangible assets for that company. Okay. On the other side of things, you have the current liabilities. This is the partial balance sheet for Google showing its current liabilities. Again, current, like these are debts that are due within the year. And long-term liabilities, this is for Nike. Again, this shows long-term, so debts that are owed after a year. Now, here's an interesting account that you haven't seen yet called bonds payable. What is a bond? A bond is simply a loan from investors. So you probably have heard about the stock market, and there's something called a bond market. The bond market is where lenders go, where investors go to lend their money. And corporations are big beneficiaries of those types of investors that want to lend. So when a company, a corporation borrows money from investors, they usually do it in the form of a bond. And that's all a bond is, a loan, a long-term loan from investors. And that's why it's under long-term liabilities. And of course, there's no change to stockholders' equity, as we mentioned. Okay, so I'm going to stop that, bring us back to our main screen. That was a little bit on the longer side, but wanted to make sure we covered what we needed to cover. You are going to have substantial amounts of things to do. It's going to be time. It's not difficult. Putting these things in order, you can't say that's difficult. Adding up some numbers, you can't say that's difficult. It's time consuming? Yes. Difficult? No. So you will be asked to spend some time doing this type of stuff. Okay. I'm going to stop that recording.